All right, guys. All right, so everything is about defining what macro structure you're in, and then that drastically shifts the odds of certain assets outperforming the other. It changes the dynamics of where you should start looking for buying the dips versus selling the rips. So let's look at this chart, guys, first. This is the, and you know what? It's kind of cool here. In TradingView, click on share, make it mine. And then I get all the chart I had back in the days, follow the annotations. I could edit them live. So let's start step one, guys. Here's the SPX divided by the PPI. As the SPX outperforms the PPI, you don't want to buy the dips in gold and silver, commodities. You just don't want to. This is a growth area for US equities. It goes up, up, up. 1920s all the way 1929, crash, 1, 2, 3, 4, 5. I don't know how many touches. Super valid trend line, breaks down. And look, so now the US equities have broken down versus PPI. Fine. But this is important because it broke down below that rising trend line, also broke down below the 7-year moving average. And during all that period, every time it tried to go back up in real terms, it could not do it. It took 7 years for it to try to do nickel bubble, and even that failed drastically. I'll bring your eyes back down here at the bottom. So here is during that period after SPX broke down versus PPI in nominal terms. This is not the adjusted one. This is just the SPX. It broke down of its own rising trend line. Here was a steeper one, but then after that, less and less steep, they're more and more meaningful. But look, it took 7 years, and even nominally, it couldn't do a new high. So just the echo bubble, once it started tumbling down, even the echo bubble was not able to go up above. It took many, many years just to break out of the base. So actually to start breaking out of the base, I'm double click here, show you my label. I don't need a label background. Oh yeah, maybe. Oh, that's nice. So it took 5,000 days, 166 months for it just to break out of this line right here. And after that, then it started climbing up. And before nominally, it even got back to break even. It's right here. So I know like not everybody bought the top here, but anybody who bought in the top, let's say the top 10, 20% of that bubble here before it broke down, it took 254 months, 7,700 days to break even. Of course, if you had dividend reinvested year after year, you could have alleviated some of the pain. But that's what happens when this macro structure breaks down, guys. All right, let's scoot over to the 1960s. Beautiful rising trend line, Nifty 50, 1, 2, 3. Here's a trend line here. There's another one here. Breaks down. What happens? Adjusted real. So no new high for SPX adjusted for PPI. It came close, but still a lower high. And on the nominal, just the SPX, it did a marginal high. So the echo bubble, it tried to get back. It did do a small high above the high before that broke down, but not that much, guys. Trapping a lot of people. And what happened? Got one more move down. And look at that. And that was 4 years later. So it took 4 years to get that new nominal high, and then it took 137 days, 137 months before that thing broke out again in favor of US equities, and that was probably 1980 right here, breaks out, retests, and off she goes. We know what happened after that for US equities. So you don't want to get trapped all that time. And look at that huge move down. You think it's the end of the world here, but that is actually that was a megaphone, broke up, higher low, and then off it went. But that's what happens. Even these nominal highs get subdued in an environment where the SPX has broken down versus PPI. So step one, SPX breaks down versus PPI. And after that, you don't trust these rallies. So even if they come up and they do marginal higher highs, you still can't trust them until it breaks up again. So once, sorry about that. Once it gets back above 7-year rate of change, a descending early breakout trend line. Once it does that, lower that line here, then you go long US equities. Then you could start believing that it's going to be time to shift. Just like we shifted when that 7-year moving average was crossed to the downside. Then you shift your bias in 1982 and you go long and you believe you buy this dip right here in US equities right there. All right, let's move over. 2000s, same thing. Third time, guys. Third time. 1, 2, 3, 4. 4 touches, breakdown. Same thing again. Macro environment as defined by this chart, this ratio chart, changes. Look at here. It took 7 years just to come back. Oh, I'm back. I'm back. No, because you're still below. You haven't broken out above here. Haven't done new highs. You still haven't defined a bottom here for the SPX divided by the PPI. So lower highs for inflation adjusted SPX, and here just flat nominally. So that's 3 times out of 3 the SPX had lower highs adjusted for PPI. And I'll tell you why that's important. So even if the SPX does lower highs or marginally higher highs or flat, and it takes you 7 years, 4 years just to break even, there's something else that's happening. There's something else you could have been playing that would, instead of just having difficulty trying to get back to all-time highs, there's something that was breaking out. And just before I show you what you should be playing when that happens, here's just what happened today, guys. 1, 2, 3, 4, beautiful breakdown below the 7-year moving average. It might bounce back up, but you can't, just like these areas before, until you do a new higher high versus the SPX as a new higher high versus PPI. That thing is in that macro defined environment where you don't trust the rallies. And there's this last thing here that didn't happen yet. So, it's like all pieces of the puzzle, right? There's still the SPX has to break down nominally, which hasn't happened yet, which happens usually after the PPI breaks down. So once the PPI starts breaking down, then you get the breakdown from that trend line, that rising trend line. Here it happened a little later. See the PPI started faltering. So we're really close, but it's not quite done yet, guys. But this is the first important signal of this rising trend line. I don't think it broke down for no reason. Okay, let's close up the show, guys. This is what has a higher chance of melting up when the PPI has broken down versus SPX. This is what you should be playing, guys. You know exactly what it is. I'll put the silver chart right there, logarithmic, and look how well it tracks. Look how well it tracks the PPI breaking down. So as the PPI breaks down versus SPX, silver rockets. As SPX breaks down versus PPI, silver has a move up, moves up, and then goes sideways. As it breaks down in the 1970s, the SPX breaks down versus PPI. What happens? Look at silver. During that whole period right here, silver just melted up, melted up. Then after that, silver goes in the bear market as US equities outperform PPI. And once PPI breaks down once again, look what silver did. Exactly as that started turning down, belts up during the whole period. And what happens after that when SPX breaks out versus PPI? Well, silver goes in the bear market. And now this is happening all over again. So instruments which are cheap are going to be gold, silver, commodities, oil. At the end of these bull rallies in favor of SPX versus the PPI, they're cheap. They're historically cheap. But for the timing, as that breaks down, then the tidal waves of capital flows are going to start shifting the other direction, and then that's when you go long the other all these commodities that haven't been like for 8-10 years, right? So it's happening right here, and I hope this helps you see the difference in between going long US equities growth stocks versus long commodities and where you are in the cycle, guys. All right, that's it, man. Thanks for watching. Do 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 do.